Okay, so we all kind of swim in this world of money, right? Earning it, spending it, trying to figure out how it all works. But I think what's really interesting, especially after going through all these sources you've shared, especially that Morgan Housel book, The Psychology of Money, it really hits you. The way we each understand this whole money thing is shaped way more by our own personal story than we might even realize.
Yeah, totally. It's not just about what the quote-unquote best financial move is objectively.
Mm.
I think the really fascinating part is why people end up with such different approaches to their finances, even if they have the same info in front of them.
Exactly. Like, why do we react so differently to the same piece of financial advice? So, for this deep dive, you've brought in this really cool mix stories, research, historical stuff. It's like shining a light on how personal our views on money really are. And, our mission here isn't to tell anyone what's right or wrong, but to really dig into the why behind our financial behaviors.
Yeah.
Where do we even begin?
Well, let's start with this. Our past experiences with money, they really set the stage for how we see things financially, especially when it comes to risk. How comfortable are we taking chances?
Yeah.
And there's some fascinating research by these economists, Malmendier and Nagel, that looked at 50 years of data. And they found this really clear link between how willing people were to take risks with their investments and, get this, the economic climate they experienced growing up. Things like, what was inflation like? Were jobs easy to find?
So, basically, like, if you lived through a recession as a kid,
Chances are you're going to be a lot more cautious as an investor later on. And the opposite holds true too. Like if things were booming when you were young, you might be more comfortable taking bigger risks. It's like that early environment, it kind of gets imprinted on you.
it's like you develop this gut feeling about money based on what you've seen. Like, think about Bill Gross, the bond king.
Oh, yeah.
Right? He's talked about how his success was tied to this long, like, multi-decade decline in interest rates. Bonds were his thing. But then imagine his dad's generation, who lived through some serious inflation. They would have had a totally different view on bonds.
Totally. Like, are they safe? How much can you really make? Their lived experience would have told a completely different story about what bonds even meant. And to zoom out even further, think about the world right after World War II. You've got Germany and Japan, totally devastated economies, trying to rebuild from scratch. And then you've got the U.S., this economic powerhouse, just taking off. Someone who lived through that crazy hyperinflation in Germany after the war is going to have a very different perspective on saving money than someone who grew up in the booming U.S. economy of the 50s and 60s.
It's like we think we're making these rational decisions based on numbers, but it's so much deeper than that. These are real lived experiences that shape our whole outlook. And it's not just about huge global things either, right? Like even individual situations can totally change how we view things. You were telling me that story about the Chinese factory worker.
Oh yeah, the one with her nephew.
Yeah. Like from a Western perspective, we might see those factory conditions and think that's exploitation. But for her, compared to her previous life, I think she had been like a prostitute, she saw the factory as a massive step up.
It completely changes the whole calculation, right? Suddenly, that factory job represents something totally different. It shows that every financial decision, even the ones that might seem baffling from the outside, they make sense within that person's own world, their history, their story. And this kind of brings us to a really important idea. No one's crazy when it comes to money.
Yeah, that one really stuck with me. We look at people making what seem like completely illogical financial choices, right? But the sources argue that what looks irrational on the surface often makes perfect sense once you understand their individual situation. Like the example of people with lower incomes spending a big chunk of their money on lottery tickets. Easy to judge, right?
Oh, yeah. But think about it. For someone in that position, that lottery ticket might be more than just a gamble. It's like buying a little bit of hope, a dream of a better life, something that feels totally out of reach otherwise. When you don't have that financial safety net, that small investment offers a possibility, however slim.
And I think sometimes when you have some financial stability, it's easy to forget that those safety nets we often take for granted, they haven't always been there. The sources pointed out that it wasn't until the 1980s that the average Social Security check even passed $1,000 a month, adjusted for inflation. And this whole idea of pensions being a common thing, not really true. Like back in 1975, only about a quarter of people over 65 even got any money from a pension.
Right, it wasn't this universal thing. So for a lot of people, that lottery ticket might have felt like one of the few shots they had at moving up.
Okay, so then you've got luck and risk, which are like two huge elephants in the room whenever we talk about financial success. Scott Galloway had this great quote: Nothing is as good or as bad as it seems. We tend to think it's all skill or all failure, but the sources emphasize how much of it is just plain chance.
Yeah, and it gets really tricky to tease apart, right? Like how much is actual skill and how much is just being lucky?
Yeah.
Look at Bill Gates. The guy's brilliant, driven, no question. But having access to a computer at Lakeside School back then, as this sources put it, that was a 1 in a million head start. Gates himself has said that Microsoft might never have happened without that opportunity.
Right, talk about right place, right time, right resources, pure luck. But then you have the flip side, the risk part. They mentioned Gates' friend, Ken Evans, super talented with computers, but his life went a completely different way. It makes you think about all the people who are just as capable, but don't get that same lucky break.
Exactly. And when we judge financial success, if we put it all on skill, it can make us way overconfident. But if we say it's all luck, it can be super discouraging. There's also this social element too, like, are we hesitant to say someone got lucky because it sounds like we're jealous or putting down their hard work?
It's such a tricky balance to strike. And to make it even more confusing, a bad decision can sometimes have a good result, and a really well thought out decision can go totally wrong. You're way more likely to see the first one celebrated on a magazine cover, right? Totally. And it brings up this crucial question. What lessons are we actually learning from these financial outcomes? The line between being bold and being reckless, it often only becomes clear in hindsight. Like, the sources talk about Vanderbilt, his attitude towards the law, almost arrogant, but it worked for him. Or Benjamin Graham, the father of value investing, putting a huge chunk of his money in Geico, totally against his own diversification principles, but it turned out to be this massive winner.
And then you have Zuckerberg saying no to Yahoo versus Yahoo saying no to Microsoft, who's making the smart move. It's hard to find, like, universal rules when luck and risk are so unpredictable.
Really drives home the point that obsessing over those extreme cases, the huge successes, the total wipeouts can be misleading. Like Frederick Lewis Allen's focus on the average American experience seems so much more useful. And there's that great Bill Gates quote, "Success is a lousy teacher. It seduces smart people into thinking they can't lose." Recognizing the role of luck when things go right is key to understanding that risk is always there.
Exactly. Keeps you grounded. And this takes us to another big idea, the seduction of more, and the crucial importance of knowing when you have enough.
This is so relatable, right? That human tendency to always want more, even when we already have plenty. There's that perfect anecdote about Kurt Vonnegut and Joseph Heller at that billionaire's party. The host is showing off all this stuff, and Heller says, "Yeah, but I have something he'll never have enough."
Such a powerful statement. And then you have these cautionary tales like Rajat Gupta and Bernie Madoff, both incredibly successful, wealthy by any standard, but they risked it all, even their freedom, chasing even bigger fortunes. What makes someone with hundreds of millions do something illegal? It's wild.
Totally defies logic, and it underlines that key principle from the sources. There is no reason to risk what you have and need for what you don't have and don't need. Sounds so simple, but clearly it's a trap that even super successful people can fall into.
And maybe the hardest financial skill isn't actually making more money, but knowing when you have enough to be secure, to live comfortably. It's about avoiding that point where you start doing crazy things, risking everything for just a little bit more.
And the sources make this great point. Some things are just not worth risking, no matter how much money's on the table. Like your reputation, your integrity. That's what Rajat Gupta realized after he went to prison.
You can't put a price on that.
Yeah.
Recognizing enough isn't about settling. It's about protecting what truly matters. Okay, shifting gears a bit. Let's talk about the power of compounding.
Compounding, that magical thing where small, consistent growth turns into huge gains over time. It's almost hard to believe how much those little gains can snowball, right? Like it defies our normal way of thinking.
Yeah, our brains aren't wired for exponential growth. It's like that analogy they use about the ice ages.
Oh.
These tiny shifts in summer temperatures over thousands of years, leading to these massive ice sheets forming. They even quote Gwen Schultz, who said, "It is not necessarily the amount of snow that causes ice sheets, but the fact that snow, however little, lasts."
It's the consistency that's key.
Yeah.
Like comparing Jim Simons, who's got these crazy high average returns, to Warren Buffett. Buffett's way richer because he's been compounding for so much longer. And they imagine what Simon's wealth would be if he had Buffett's time horizon. It's mind-blowing.
Totally. It shows that even small differences in growth over decades can lead to insane results. And think about technology. like data storage, going from megabytes to terabytes in a few decades. We underestimate exponential growth all the time. Even Bill Gates didn't see the need for all that storage space when Gmail launched.
Our intuition just doesn't grasp it. The sources actually suggest that the best finance book might just be called Shut Up and Wait. It's all about the long game.
Absolutely. And the stories of Jesse Livermore and Abraham Jermansky during the '29 crash, they highlight how short-term success doesn't mean long-term success. Livermore made a killing, but then lost it all because he got overconfident. Jermansky got wiped out too. Staying in the game for the long haul, that's crucial.
So that brings us to survival, right? And having this margin of safety in our financial lives.
Exactly. To be successful in the long run, you've got to weather the storms, stay invested long enough for compounding to work its magic. Andrew Grove from Intel famously said, "Only the paranoid survive." And there's another great quote from his colleague who said they were always afraid of going out of business, even when things were going great.
It's like planting those oak trees. You've got to make sure they survive the storms to reach their full potential. You know that story of Buffett, Munger, and their old partner, Rick Guerin? It's a perfect example. Guerin was brilliant, but he was using too much borrowed money, so when the market tanked, he had to sell his Berkshire stock. Buffett and Munger, with their patience and their cushion, they were able to buy more. And Buffett even said about Guerin, he was in a hurry.
It shows the power of having that margin of safety, that buffer room. It's not about being super cautious, but about increasing your odds of success, having a conservative budget, thinking flexibly, having a long time horizon. It allows you to withstand those unexpected hits.
And they talk about having a barbelled personality. You're optimistic about the future, but also a little paranoid about the short-term risks that could derail you. It's like knowing that the path ahead will be bumpy, even if the overall direction is up.
And history is full of examples, right? Market crashes, inflation, doom and gloom. But over the long term, living standards have generally gone up. Investing, it's going to have its rough patches. Don't overreact to every little dip.
Like Walt Disney, early on, his studio went bankrupt, tons of failed cartoons. But then you have these massive hits later, and it's not just him. Data from venture capital and the stock market shows that most of the returns come from a small number of big winners. The sources even talk about Coralco Pictures, this seemingly successful movie studio that went bust. It's a common story.
And they have this example of three people investing through recessions: Sue, Jim, and Tom. Sue just keeps investing steadily. Jim and Tom try to time the market. Sue ends up way ahead. It really shows the power of just staying invested. And it backs up George Soros' point. It's not about being right or wrong all the time, but about how much you make when you're right and how much you lose when you're wrong. You can be wrong a lot and still do great if you manage your risk and let your winners run.
It's the long game and making sure you're still in the game to see those big wins.
Okay, so then there's the whole question of what wealth actually means and how it connects to happiness.
Right, because it's not just about the numbers. The sources define real wealth as being able to wake up and say, I can do whatever I want today. It's about control, freedom, having choices.
It makes you think about why we chase wealth in the first place. We assume it equals happiness, right? But research shows that happiness doesn't keep going up as you get richer, at least not past a certain point.
Totally. Like that story of Derek Sivers, the musician. He quit his job once he had $12,000 saved. For him, the freedom, the control over his time, that was the turning point.
It's interesting the U.S. is one of the richest countries ever, but we're not exactly winning the happiness rankings. We're stressed, we worry.
Maybe it's because we've traded time for stuff. We have more things, but less control. Especially with technology, it's like we're always working. As Derek Thompson put it, the factory is the day itself. We're never really off. And then there's this human need for respect, for admiration. The sources talk about how buying fancy things like a Ferrari, it doesn't necessarily get you that. It might be more about humility, kindness, those things that really earn respect. It's like that perspective from the valet who sees all these flashy cars come and go.
You never know who's actually wealthy. Real wealth is often hidden. It's in the savings, the investments, not the stuff you show off.
Yeah.
Like the story of Roger with the Porsche. He's trying to look rich, but then you have Ronald Reed, the janitor who quietly amassed a fortune and became a philanthropist. It's about what you don't see.
And they make a great point. Building wealth is more about your savings rate, which you can control, than just investment returns, which are unpredictable. It's like energy efficiency. Focus on what you can influence.
Savings give you options. You can chase purpose, not just profit. You can wait for the right opportunities. In this crazy competitive world, adaptability is key. It's not just about being smart, it's about being flexible.
And that ties into this idea that maybe it's better to be reasonable with money than strictly rational.
It's a crucial distinction. We're not robots. Emotions play a huge role. Like that analogy with fever. Even though we know it can be good, we still want to get rid of it because it feels bad. Same with money. We try to be rational, but emotions get in the way. Like that story about Harry Markowitz, the Nobel Prize winner who created this super rational portfolio theory.
Right, but even he wasn't using it at first.
He realized that being reasonable, being comfortable with your choices, that matters more than just following a model perfectly. Like those Yale researchers suggesting young people use margin to boost savings, might make sense on paper, but in reality it might be too risky or just feel too uncomfortable for a lot of people. And the key to long-term success in investing, it's sticking with your strategy, even when things are rough. Look at the historical data. The longer you stay invested, the better your odds of making money.
So maybe that whole do what you love advice, it's more than just feel-good stuff. It might be about finding something you can stick with long enough to let the power of time and probability work in your favor.
Persistence is key. And speaking of time, let's talk about the limits of using the past to predict the future, especially in finance.
Yeah, the historians as prophets fallacy, assuming what happened before will just repeat itself. But the world is constantly changing, especially with money, like the rise of 401ks and Roth IRAs, the whole venture capital world exploding. You couldn't have predicted those from historical data. Even classic books like The Intelligent Investor, while super valuable, they're not like step-by-step manuals.
It's more like card counting in blackjack. You're playing the odds, but with humility. You know things are uncertain, so you have to have that room for error, enough money to handle some losing streaks. It's not about being super conservative, but about making sure you can stay in the game long enough for the odds to swing your way.
And that room for error isn't just about money, it's about emotions too. Like, how much can you handle before you panic and make a bad decision, especially when your family's involved? That's why I always build in a margin of safety when I'm thinking about future returns, like assuming they'll be lower than the historical average. Charlie Munger said it best. The best way to achieve felicity is to aim low.
It's about being prepared.
Yeah.
Even with great odds, you got to avoid that small chance of blowing up, especially if you're using leverage. It reinforces the idea of that barbelled approach. Take calculated risks in some areas, but be super safe in others. You want that long-term security, that control over your time. That's the ultimate return on investment. And don't forget about those black swan events, the totally unpredictable stuff. You can't foresee it all, so you got to have multiple backup plans like redundant systems in an airplane.
Okay, last big idea. The end of history illusion that we basically assume we'll always want the same things.
But we change. Our priorities shift. Life throws us curveballs. It's like that story about the person who wanted to be a doctor no matter what. They finally get there, and they hate it. Financial plans need to be flexible to account for those changes.
So no need to go to extremes. Whether it's super strict saving or chasing every dollar, you might regret it later. And it can be really hard to keep that long-term view when the market's going crazy. But that volatility, it's the price of admission to the game, right?
The fee you pay for those potential returns, like Netflix, Monster Beverage, huge swings in their stock prices, but massive long-term gains. Trying to avoid that volatility can backfire. Remember all those accounting scandals like GE, Freddie Mac, Fannie Mae, trying to smooth out the returns and hide the risk? It doesn't end well.
Gotta be willing to ride the roller coaster to get to the destination. Okay, last but not least, the siren song of bubbles.
Bubbles are tricky. After they burst, everyone was like, that was obvious. But in the moment, it's hard to see. And no one ever agrees on what caused it or who's to blame.
Yeah, hindsight's 2020.
And yeah, in short-term trading, momentum can drive prices way beyond what seems rational. But for those traders playing that short-term game, it can make sense. It's a different game than long-term investing, where you're looking at the underlying value of things.
That's why they recommend having that personal financial mission statement to keep you grounded, to remind you of your goals when things get crazy.
Yeah.
Okay, one last thing that really struck me. Why does pessimism always seem so much smarter than optimism?
Right. Like, it's got more gravitas. The historian Deirdre McCloskey put it perfectly. For reasons I have never understood, people like to hear that the world is going to hell. Pessimism sounds more sophisticated, it gets more attention. Optimism can seem naive.
But the sources talk about realistic optimism, believing that the odds are in your favor over the long term, even with those inevitable setbacks. It's not complacency. It's about acknowledging that things generally tend to improve, even if it's slow and messy.
Like that story of the Russian professor who predicted the U.S. would break up in 2008. Got a big article in the Wall Street Journal. But how often do you see these crazy optimistic predictions treated seriously? It's always the doom and gloom that gets the attention.
And history is full of surprises, too. Like Japan, totally devastated after World War II, and then they have this incredible economic boom. You can't always predict those turnarounds.
And it's funny, there are tons of pessimistic investment newsletters, even though the market has gone up over the long term. We tend to focus on the negative. Matt Ridley said, the world is getting better and most people don't know it. Hans Rosling had a similar idea. We systematically overestimate the negativity in the world.
I guess it makes sense, though, right? Financial bad news, it affects everyone. Even if you don't own stocks, you pay attention when the market crashes.
It's in your face. And bad things, like bankruptcies, wars, they grab our attention immediately. Good things, like the Wright brothers inventing the airplane or medical progress, those things happen gradually, so they don't make headlines.
Like the decline in heart disease deaths. It's huge, but it happens slowly, so it doesn't get the same buzz. And sometimes those economic downturns, it's more about fear and negative stories than the actual economic damage.
Confidence plays a huge role, which leads us to another interesting idea. You'll believe anything when it comes to money, especially if the story is good enough.
Right, when the stakes are high and we don't have all the information, we grasp at anything that gives us a sense of certainty, even if it's not true. It's like that example of pre-scientific medicine with all those crazy treatments that didn't work. But people were desperate, so they believed anything that promised a cure.
Same with finance. Why do people fall for bad investment advice or those Ponzi schemes? Because they want to believe in that easy money story, even if it's too good to be true. And it's not just adults, right? Even little kids create these simple stories to explain the world, even when they don't know much.
It's how we make sense of things.
And as adults, we do the same, but with bigger consequences. We oversimplify things, we don't even know what we don't know, and that can lead to some big misunderstandings about how the market works, which can even fuel bubbles.
Okay, so now we're at the confessions part, where we admit that financial advice is super personal, one size doesn't fit all.
It's like how medical practice has changed, right?
Yes.
From doctor knows best to a more collaborative approach, where the patient's preferences matter. Same with money. Everyone's got different goals, different timelines, different values.
Exactly. So we're not going to give specific advice, but the sources do offer some great general principles based on everything we've talked about. Be humble when you win, forgive yourself when you lose, be prepared for things to go wrong, use money to buy freedom, control over your time, be kind, don't be flashy with your wealth, earn respect through your actions, not your possessions. Make room for error a priority. Don't make extreme decisions based on who you are right now because you'll change. Take risks, but avoid those that could ruin you. Define your own game. Don't worry about what others are doing. And remember, smart people can disagree about money because they have different goals.
And building on that, you've shared some of your own personal strategies, making it clear that this is what works for you, not necessarily for everyone. Like figuring out your lifestyle needs early on so you can save a lot without feeling deprived. Making financial independence your top priority. Owning your house outright, even if it's not the most financially savvy move, just for that peace of mind. Keeping more cash than usual so you don't have to sell stocks when the market dips. Investing steadily in index funds. No fancy stuff. Just relying on saving consistently, being patient, and having a positive long-term outlook. You believe that all that effort trying to outsmart the market, it doesn't always pay off. The real returns come from a few key things.
Right, it's the basics, done consistently over time. And then we have this postscript that gives us some historical context or how the U.S. consumer ended up thinking about money the way we do. It's really interesting, starting with the end of World War II and this whole push to create a consumer-driven economy. Low interest rates, easy credit they wanted people spending.
It was like a strategy for economic growth. And there was this post-war boom, pent-up demand, new technologies, rising productivity, returning soldiers, found jobs, making all these new products. Everyone was spending, the economy was humming, and the gains were pretty evenly spread out, more so than today. But then in the 70s and 80s, things started to shift. Growth continued, but it became more unequal. The top 1% saw their income skyrocket, while everyone else saw much smaller gains or even declines.
But those expectations from the post-war era that you should have a certain lifestyle,
Okay.
that debt is normal, they didn't disappear. So debt levels kept rising even as incomes for most people were growing more slowly. Houses got bigger, cars got fancier, college got more expensive.
And it was all fueled by easy credit until it wasn't. Like Hyman Minsky's idea of debt crises when people borrow more than they can handle, that's basically what led to the 2008 crash.
And it's tough to break those patterns, those expectations. And policies like tax cuts can sometimes make the inequality even worse. So, while there are good things happening, the feeling that this isn't working for a lot of people, it's understandable. It's like history repeating itself in a way.
Yeah, there are cycles. But overall, the big takeaway from this whole deep dive is that our individual views on money, they're deeply shaped by our personal stories, by the economic world we've lived in. And understanding that can make us more understanding of others' choices and more aware of our own biases.
There's no one right way to handle money. It's about what works best for you, your goals, your values. And that leads us to a final question for you to think about. What were your early experiences with money? How have the economic times you've lived through shaped your beliefs about money? And are those beliefs still serving you well today in this constantly changing world?
Something to ponder.
Definitely food for thought. And hey, maybe go back and check out those sources again. There's so much in there.
Lots to unpack.
Thanks for joining me for this deep dive. It's been fascinating.
Absolutely. My pleasure.